Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Ari.
Hello.
And his lovely White Castle shirt right there. If you guys are watching, listening on YouTube, see his beautiful t-shirt.
It's the Breakfast
White
of
Castle.
Champions.
Breakfast of Value Investors, huh?
Yeah.
We're not sponsored by White Castle, just to be clear.
Yeah, it's cheap until the heart attack, and then it gets very expensive.
Exactly. It's fitting that you say that because he himself is a doctor, medical doctor.
Obviously not a very good one if I eat there, though.
Exactly. All right. In this episode, we will talk about the Darden restaurant, the second part of this episode that covers financial management and valuation. Again, quick three things, housekeeping items. If you want the checklist, we go through a checklist that we put together for every company that we analyzed. If you would like a copy of the checklist, email us at info@valueinvestor.org. Again, info@valueinvestor.org. We also have a community where you can talk to us directly. You can talk to the community at large, our listeners. So email us for that as well. And lastly, if you'd like us to cover a company that you have in mind, also email us at info@valueinvestor.org or leave us comments or reach out to us on Twitter, whichever way you prefer. All right, let's get right to it. Hari, actually, quick disclaimer before we jump into the checklist, please.
Yeah, this is the Value Investor TV podcast. We are a podcast that helps educate you on the concepts behind value investing. We are not financial advisors. We don't know your specific financial situation, so please consult with the appropriate advisor before making any investment decisions.
All right. Don't trust us is what Hari is saying.
Yes, exactly.
Entertainment purposes and educational purposes.
But you can send us money. We're okay with that.
Yeah. Send us plenty of money. We'll go to White Castle with it.
Yeah.
How's that?
Yeah.
All right. This episode, we are continuing our conversation with Darden Restaurant. Just to quickly highlight what we talked about in the last episode. It's a company. It's a sort of a umbrella company that owns a bunch of restaurant brands, namely Olive Garden is a really famous one that they own. Texas Longhorn Steakhouse is another one. So it's a collection of restaurant brands. They have brands. The brand moat is the biggest moat that they have. They have some low cost and intangible asset moat that we talked about in the last episode. And because they're in the restaurant business, it does require a lot of capital reinvestment. We said about a third of their free cash from operation goes into capex, and no red flags in terms of relationship management. So no red flags in terms of customers, suppliers, employers, employees, regulators, etc. All right. So the next question on our checklist is the company able to translate its moat? And we talked about a couple. 3 of them in the last episode. Is the company able to translate its moat into high returns on capital?
Yeah. So the interesting part about this business is the answer to that question is yes. They actually they generate about a 30% return on equity. And I want to highlight I think return on equity is actually appropriate here. They're not an over-leveraged business for a company who has as we talked about on the cash on hand and so forth, their total assets were $9.9 billion. And what's interesting here is that in 2019, they were not documenting operating leases as as a liability until 2020. And what's interesting about that is they actually have a liability for the operating lease, which is what many companies, if you have a lease with a landlord, you put that on the balance sheet. Additionally, what they would do is they actually have an asset that they call operating lease right of use asset. So that roughly cancels out the debt. And so their equity didn't change over time. So it's actually easy to compare apples to apples comparison because they have this asset and the liability that kind of offsets it. So even though they have to pay $3.5 billion over the next however many years they have leases, they still have an asset that they can use, because there is an operating lease that they have a right to use that, so they basically get 3.3 or $3.9 billion of operating leases as the asset and a liability. So this kind of balances out the equity base, which is, I think, appropriate because yes, you do have to pay that money out, but you also have the right to use that, lease, for your restaurants. So taking that into account, the equity base, was roughly staying the same. And so as a result of that, you get around 30% return on equity, which has been, is a very good number for a restaurant, right? Restaurants are not typically extremely profitable. Their equity base is floating around 2.3 billion, and has steadily grown. From in 1997 it was 1.08 billion. So it's kind of over time doubled, while they've maintained reasonable debt levels, in the 900 million range. But they did have to take on some debt, which is not reflected in the May 2020 because of COVID. So we'll have to look at those when the next quarterly earnings come out to kind of look at the debt levels there. But from a balance sheet perspective, it's the return on equity of 30%, I think, is a very solid number.
That's a very respectable number. Not only within restaurant business, but overall any business wise.
Yeah.
Return on equity of 30% is a quite respectable number there.
Right.
So that's great. So they're doing something right in terms of leveraging their moat and turning them into high returns on capital.
Yeah.
All right. So moving on to more, doing more deep dive into the financials. Does the company have enough cash to maintain its business? You remember you said $9.9 billion in cash equivalent. Did I hear you right?
That was total assets.
Total assets. Okay.
1.1 billion of that is current assets. And they have a these trademark and goodwill account for almost 2 billion, 1.8 billion of their assets. So this is goodwill from the acquisitions that they've had and trademarks that they have acquired, which are being amortized over time. But their tangible assets is around, the current assets is 1.1 billion, and 760 million of cash. So in a normal year, they were generating about 800 million in free cash flow. That was in 2019, and it was up from 620 million in 2018. So, they are generating a decent amount of free cash flow also. And so I look at that as they have a comfortable, manageable load of, based on cash flow.
Makes sense. And does the company maintain reasonable debt level?
Yeah, so we kind of talked about that. We'll have to see what it looks like. 900 million was what the debt level was. But they also took 750 million from a revolving credit facility, 270 million in new loans. So that's almost $1 billion that they've, so they almost doubled their debt. And their follow-on, they did 505 million of follow-on equity. So they basically diluted themselves to raise some cash. So I think that's, considering what has happened, I think that's acceptable. They generated a decent amount of free cash flow, so I don't think it's going to really hurt them long term. So,
Also, just a quick glance at their balance sheet and their free cash flow. The management, you said, they've been around for a long time. This management sort of racked up the debt right after 2008 crisis. Around 2008 crisis, the debt went up all the way to like 2.7 billion dollars, and they were able to pay it back. It went all the way down to $400 million.
Yeah, so they've done a good job maintaining their finances, and I think, to be honest with you, I think this is a conservatively financed company. There's no reason to take on debt. So I would give management high marks for not being foolish with, oh, we're gonna double our business. Let's take $3 billion in debt, and then now this is a albatross that's eating away all their cash flow. So
yeah, makes sense. And then we kind of talked about the last bit here. Can the company generate a strong amount of free cash flow from operation? I think the answer is yes. Do you have anything else to add to that question?
Yeah, I mean, I think 2020 is going to be, or 2021 is going to be a good indicator of how quickly, things return to normal. I want to see what the winter of 2020 looks like too, because that's kind of their good year, or their highest performing quarter in terms of revenue. So, really what we want to look at from a company perspective is how are they doing, through this pandemic time. And I think they're going to be fine, but they have a lot of brands that they talk about, and their various levels of, profitability for each one, which I didn't really dig into very much, but some of these more expensive luxury brands, are they going to be okay? Is it going to be the more middle tier brands that are going to hurt more? So that's all the stuff that you would want to watch going forward.
Mm-hmm. All right, so let's move on to another batch of questions. This one's related to management, and you talked about higher marks for management, that they didn't take on this huge debt, pretty conservative financed capital structure, which is great. So let's just dig into that a little bit more. Is the management properly incentivized to protect shareholders' interest over its own?
So I'm actually gonna spend more time talking about what they're doing with my capital, if I were to own this, because I didn't actually dig into the management incentive structure, because part of it is because this is a company that has over time, since 97, they basically cut their shares outstanding in half, from 240 million shares to down to 122 million shares. And so, and all the while they were paying a reasonable dividend. And so part of my concern here is that, with a business like this, their dividend is now suspended. Their share buybacks are suspended. It's a slow growing business. When am I going to see a return, right? This company has to be fairly cheap in order for me to actually want to invest in them, because if I'm not going to see a return for 2 or 3 years, then because they're have suspended all their share buybacks and dividends, this isn't a great time, right? So I'm in my mind, their capital allocation has to be very closely watched now, as opposed to, I think I would agree that their capital allocation has been very good in the past. Now I would like to see them, how are they going to respond to this current, the current crisis?
Mm-hmm. Have you noticed, this is one of the last questions here in the management, have you noticed any red flags in terms of their honesty, openness, anything there you can tease out?
No, they're pretty straightforward. It's a straightforward business. It's, not a lot to hide in here. It's a good, well-run business, high return on equity. My biggest concern is, when is the return to shareholders going to start again?
I see. All right. Let's get to the final bit here on valuation. Hari, take me through your assumptions and the final valuation, intrinsic value calculation.
So I'm going to assume that this company has returns to their normal cash flow, which may be aggressive, but I'm going to consider 800 million as their free cash flow initial cash flow value. And I'm going to take a fairly low growth rate of 5% for the first 5 years, 3% for thereafter. So basically, this company will match inflation long term. And our discount rate is always 10%. I'm using 123 million shares outstanding, and we actually have 930 million in debt. So with our updated balance sheet, I'll give you the first without the with only $1 billion in debt first, and then we'll double it and see how that affects our valuation. But we get an intrinsic value of $99 per share, margin of safety price of $49.40. So right now they're trading at $87 a share, as we record this. So, they're not exactly cheap, right? If you had watched them closely during the pandemic, you would have probably been able to get them for, in March, you would have probably been able to get them under $40, which was, roughly where our margin of safety price is. If you look at this as a, with the debt load higher, I don't really see how this, this is not a business that I can kind of, with 1.9 billion in debt, the intrinsic value is around $75 a share, margin of safety price around $37 a share. So it's pretty expensive. I don't see how you're going to get your money out of this, out of this company fairly soon. So, my concern here would be, and I would want them to be, if they are actually buying back shares, I want them to be buying back shares at a lower price than this, right? I would prefer actually that they paid a dividend right now. And, that was like $2-3 a share. So you're getting like a 3% return, from the dividend. So there's not a whole lot right now that makes me just excited about this company. I think it's a good business. Under $40 a share, I would seriously consider it, but it's more of a one-time, value play rather than a long-term hold for me.
Mm-hmm. Makes sense. I mean, in terms of the long-term growth runway, right, it's very limited upside, and you're really looking for, it seems almost like a somewhere in between cigar butt strategy and then long-term, very, very, very good company at decent price, not cheap price, but decent price, right. Somewhere in the middle there.
Yep.
Yeah. But it sounds like the intrinsic value is right now it's trading at around intrinsic value.
Yeah.
From your estimation, but of course we want to get it below that. So, all right. That sounds good. Anything else you want to add to this? Ari?
The only thing I would say is that, if you're a beginner and you're looking for a company to start, to evaluate, I would say Darden is probably a good one to look at. We've mentioned a few of them in the past, like Skechers was a good one. These are relatively simple businesses where, there's no real complex accounting. The business is pretty easy to understand. So if you're new to this and you're like, I'm, I've listened to you guys before, you've talked about all of this stuff. I would highly recommend looking at a company like this as your first 10K, right? If you're going to read one, this one is a very straightforward business to analyze. There's not a lot of magic to what's going on. And I think you'd have a good chance of kind of analyzing this. It's a good business to learn from and, to try and understand, and test your concepts. So, may not be the greatest business to own right now or at this price, but, we don't, I think we get this question a lot. Why do you guys always talk about so many businesses that aren't, cheap enough to invest in? And the reality is that this is what investing is, right? Is you're going to spend the majority of your time finding businesses that are too expensive, but they're good. And if you were savvy in March, you could have paid, for this company, and you would have doubled your money, right? More than doubled your money. So that's the purpose of value investing, right? Is you make that list and you keep that list up to date, and then when stocks go on sale, you have the opportunity to buy them, right? And so it's very important that you focus on that, on keeping that list up to date. Because I will tell you, in the Slack channel, I heard from a lot of our investor, our people who are saying, I'm going to wait until it drops even lower. It drops even lower, and that day never came, right? And a lot of them missed out on opportunities to buy. And so you have to be very mindful of that, because the price that you pay is an absolute, right? It doesn't matter what's going on in the world, right? It's you buy some percentage of your stock, and then you just keep going as long as it's below that margin of safety, price. So,
yeah, absolutely. All right, sounds good. Hope you guys enjoyed this episode, Darden Restaurant. I learned about Darden Restaurant. I didn't know about them, but thanks, Harry, for taking us through that. If you guys have a company that you have in mind, again, email us at info@valueinvestor.org. We'll take a look at them for future episodes. And again, if you'd like a copy of our checklist, email us, again, info@valueinvestor.org. And the Slack channel that Hari mentioned, if you want to be part of that also, email us to the same address, info@valueinvestor.org. All right. Thanks, everybody. Stay safe, and I'll catch you guys in the next episode.
Thanks.